Hi guys, this is Ronan Itkovich from skillsofthetrade.com. I would like to share with you my analysis of the US market today and opening up the chart for the Russell 2000 index, which is a representation of the US market. We can see it, and as you might have already known, there has been a major downturn of prices in the US market. Prices have been dropping quite rapidly. And really, if you take a look at the chart here, the Russell 2000 is very clear in its technical um, analysis that it's been, it's been very kind of risky over the last several weeks, because if you take a look at the chart and place resistance line, we can see from the top of the previous historical resistance, we have entered territory that is a resistance zone. And so right away we should be careful of entering new positions when the price has hit a historical high. And this is what the market has been at, or the price has been at, over the last several weeks. And we can see that the price has been in the overbought zone, which can indicate that the price might reverse down. Another indication that the price might reverse down is this bearish divergence we see at the MACD histogram, which means that as the prices go up, the MACD histogram is creating lower lows, lower highs, as we can see. And that's a bearish divergence, another sign that the price might come down, and we should be extra careful with our positions. And one more thing is that we can see a few weeks ago is this is the weekly chart, that the price gapped down and opened up with a gap on the weekly chart. That's a very major sign that the price will continue to go down. The sellers came in and just sold a bunch of stocks all over the US market. And so that's a major sign to exit short-term positions if you haven't already. Of course, this is in hindsight, much easier to see, but still, it is an indication that the price will go down from this gap. So we can take a look at really the whole market as a whole. We've been on a bull market somewhat from 2009 by taking this line and stretching it just below those valleys. And you can see that every time the price comes down and comes very close to the upward trend line, the price has a chance of moving up. So there is a chance of the price moving up at this location, but it's still too early to say what the market will do. Usually before a market makes any changes in moves, especially any type of change, it will come down to test for support at least twice before continuing up. We can see here at the 2008 financial crisis, the price has been coming down really for 1, 2, 3, 4, 5, 6, 7, 8 weeks. That's 2 months of coming down. And then it created what we call a double bottom. And this is what we really would like to see before entering any new positions. This double bottom. This whole process is about 6 months before even the prices start continuing up. So anybody who thinks that this is a good time to buy is fooling themselves. because we still don't know what the price might do. I mean, if we take a Fibonacci retracement tool and stretch it from the bottom of this bullish market all the way to the top, we can see that we have just this week, today, reached an area of support, which is also the 38.2% Fibonacci line. Now, the price might actually reverse and start continuing up, but not before stabilizing in this area before continuing up. This stabilization process might take some time, maybe several months to 1 year. This is the weekly chart, so it might take actually 6 months, 4, 5, 6 months at least, before we can stabilize this major down movement and begin to see clear signs that the market is reversing. The prices just don't reverse just by within weeks. They take months with this type of major downturn to reverse themselves, especially for long-term investors. So the price might reverse over here, or it might actually continue down to the 50% Fibonacci line, or even the 61.8 Fibonacci line. And that's why I think we should all be, remain out of the market until it's clear of what the market will do, especially for long-term investors and long-term traders. If you are in the positions right now with holding long-term positions, you can either exit and wait to see what the market will do in several months after it has stabilized and then re-enter, or just hold on to your positions and the market should stabilize within several months to be able to know what's best, when is the best time to enter. So right now I would just hold off on any positions and wait to see what the market will do. I think it is too early to say that to buy anything, and we should just wait and see what happens. I hope you guys gained some value from this video. If you would like to learn more on how I'm able to read charts and analyze price movements and price data, I've written a really good book that's available on Amazon. It's called Stock Trading 101. It's a practical beginner's guide to stock trading and technical chart analysis. Now, in this book that I've written, I've really made it easy for the beginners who are visually minded to be able to see and understand how the market works, especially with charts. I've included over 130 colorful charts and illustrations. And in this book, I've detailed on how price movement move, how you're able to see price patterns and Fibonacci retracements, and really to go further into my strategies on how I trade, risk management, and much more. I will leave a link in the description for you guys to check it out. I hope you guys take this time to really learn about the market and how to trade properly and safely in it. Until next time, I'm Ronen Itzkovich.